Jeannie Boyle is a financial advisor for an ethical firm called EQ Investors, which will show you alternatives or sustainable alternatives to invest your pension and other capital assets. Without further ado, over to you.
Thanks,
Jeannie.
Stephen,
thank you.
And thank you for the invitation to join you. I've got a PowerPoint presentation, but I don't want to sort of PowerPoint you all to death with loads of facts and stats and everything. So I'm really happy if you want to chip in as I'm going along. There's loads and loads of people, so feel free to join in at any point. Oh, can someone let me share my screen, please?
Yeah, that's Deborah's department. I'm sure she'll do that.
So I've tried to make this not too much of an advertorial for EQ Investors and more general information about investing. So forgive me if I stray into too much of the other side. So let me
You should be able to share it now, Jeannie.
Cool.
It's that old BBC adage, isn't it? There are other some ethical investors out there.
There are other options out there. Obviously, they're not as good, but here we go. And the other thing is I've got my notes on the other screen, so I'm going to do a little bit of this, but I am concentrating on you guys, and I'm just going to make sure I'm pressing all the right buttons. So yes, thank you for the introductions, Stephen. We are, as Stephen says, we are a financial planning and investment management firm. We're one of the only financial advice companies in the UK that's staff owned. We're owned by our staff and by our charitable foundation. There's about 60 of us based up in the City of London. I'm based down in Brighton, where I live. And we have been focused on sustainable and impact investing since 2008. We look after £1.7 billion worth of money for individuals, mostly for charities and companies. It sounds like a lot of money, but it's not really. We're quite a small company, really, in the general scheme of things. And we were also one of the first companies to certify as a B Corporation in the UK. And that's something that's just really fundamental to us. Our belief is that businesses should have purpose and should be good citizens of the world. And our mission is really to bring sustainable investing to people and make it easy for people to make good choices about their money. I'm one of the financial planning team there, so I look after individuals, and pretty much all of my clients are interested in sustainability. So I'm going to talk a little bit about why money is important in all of this. I'm going to talk a bit about our approach, and sort of from that about general approaches to how you can introduce sustainability into your pensions and investments, and then maybe just finish off talking about some specific things you might want to think about if you're thinking about making different choices with your pensions. So, I mean, first of all, why is this important? I mean, I think it's one of the slightly sadder truths of the 21st century that sometimes choosing how we use our money is one of the most impactful things that we can do. If you're someone who is perhaps slightly cynical about the state of our democracy and the limited choice at the ballot box, then actually changing how you spend your money and how you invest your money can be quite a powerful thing to do. And we often think about investors, our mental images, some jowly middle-aged man in the City of London with a briefcase and red braces, but anyone who has a pension is an investor, whether it's being done on your behalf or you're making the choices yourselves. And you might be familiar with the Make My Money Matter campaign that's being run by Richard Curtis, which is doing fabulous things. They think that there's £3 trillion invested in UK pensions. And a trillion is a number that kind of makes my head explode a little bit. It's 1 million times a billion, which is a huge, huge sum of money. There's another 600 billion that we have in ISAs in the UK, and all of that money could be invested in creating change. And these funds that we have and that we control can be directed towards that change. And we think there's 3 real ways that you can do it in terms of investing. And firstly, you can divest and avoid the worst companies out there. And that has the effect of making capital more expensive to them. In the long run, it will make it harder for them to go about their business. You can engage with perhaps people who are nearly there or the laggards and try and encourage better behaviour by using share power. And that's where shareholders as groups can be really influential. And there's a great organisation you're probably familiar with called Share Action, who does exactly that. And then the final way is you can proactively invest in the best companies, and that rewards those companies and shows the market that innovation, good corporate behaviour leads to higher share prices. I'm not going to linger on all the things because you already know about all of these things because you're a climate forum group. So you know what you can do. But in the context of that, making a change to how you invest can actually be really impactful. So we think that an investment of about £20,000, so your ISA allowance, is roughly equivalent to the carbon saved when you take a car off the road for a year. So again, you might be familiar with some of these figures. There were scientists at the University of, I think it's Lund, which I'm probably saying completely wrong, that tried to assess what you can do that actually makes a difference. And their findings were that switching to a plant-based diet, going car-free, flying less, and having fewer children were the most impactful things you could do when it comes to your own personal carbon footprint. And we think that actually changing your investments rates quite highly on that scale in terms of the actual carbon that's saved. So by changing the way you invest your pension, you can actually have quite a big impact on your personal carbon footprint. So just to give you a bit of context and understand how this sector has evolved, I thought I'd talk you through our journey on this. So Eco Investors has been around since the 1990s, and it started life as a very traditional investment advice firm in that we helped our clients invest to make money, and that was all we really did. But in the early 2000s, we started working with a group of faith-based investors who were interested in using their money in a very different way. And they were very clear that they weren't thinking about giving money away because it is investments they needed for their financials, their family's own financial security. But they wanted to use their investments to have a beneficial impact on society or the environment. And we started working in direct microfinance in Sierra Leone, which, if you're familiar with the sector, it's hugely impactful. Microfinance loans are an incredible way to change lives and create development. But for an investor, it's highly risky. There's a very high chance that you may not get your money back when you need it. And that experience showed us that there was a demand for an investment that went beyond simply taking out things that were negative and introducing things that made a positive change. But what was really important in this was managing risk. When we're talking about people's pension funds and their ISAs and the money that's key to security, we have to make sure that you can get your money back as and when you need it, rather than waiting for someone to pay back a loan that may or may not happen. So liquidity is key to this, making sure that money is accessible. So we tend to invest now in public markets so we can ensure that people can get their money back when they want it. So we set up our impact portfolios in 2012, and they were for a long time one of the only options available that took a positive approach rather than a negative approach to investments. And then a couple of years ago, we launched something similar called the Future Leaders portfolios, which were designed to be sustainable but at slightly lower cost. So one of the things that's quite difficult, sorry, my cat's just going to join us now. One of the things that's quite difficult to get your head around in the world of sustainable investing is the different jargon that we use for different ways of investing. So we call this chart here the spectrum of capital. And at one end, you have traditional investment, where you're investing to make a return, and really you don't have any concern for any externalities or how you go about making that return. It's just about making money. And at the other end of that, we've got philanthropy, where you're just giving the money away and there's no interest in financial return at all. And most people who are interested in sustainable investing, which is a term I use as an umbrella to sit across these three middle sectors, are in between that. So if we were having this conversation about, I don't know, 10, 15 years ago, we'd have been talking about ethical investing. We'd have been talking about a way of investing that seeks to avoid harm. So taking out the so-called sin stocks, the alcohol, the gambling, the tobacco, which is great, and it makes people feel more comfortable that they're not investing in anything that they find abhorrent, but it doesn't go that step further. It doesn't do anything positive. And people often found that they ended up with portfolios that just kind of had big gaps in them. So in the last few years, people have been thought more positively about how they invest. So we now have these two other terms that we use. So ESG investing. ESG stands for environmental, social, and governance. And these are the criteria that investors use to assess the risk and the activities of the company. So an ESG investment will usually seek to avoid harm. It will go a little bit further than an ethical investment. It seeks to what we call benefit stakeholders. So by stakeholders, we're talking about the people who work for the company or the community that surrounds that company. And ESG investing is really about assessing the operations of the company. How does it behave? Does it treat its workers fairly? Does it consider environmental risks? Is it well governed? Does it donate to political parties? Is it involved in corruption scandals or anything like that? And usually the avoiding harm is a byproduct of that. The way that people use ESG criteria varies hugely. And it's possible, to take an ESG approach simply as a way of assessing risk. You might say, look at oil as a sector and just say, I'm ambivalent about whether I think this is morally right or wrong, but I see this sector as being at risk of future profitability for environmental reasons. So ESG approaches can vary greatly in terms of what type of companies are avoided. And most ESG strategies or funds that use an ESG strategy, you'll see, will also list out the things that they avoid. Going along from there, we have what we call positive impact investing. And that does all of the same things in terms of seeking a return, avoiding harm, benefiting stakeholders. But beyond that, the idea is that it contributes to solutions. Impact investing is about investing your money in the companies whose product or service is helping to meet a social or environmental problem. And that's quite fundamental. If you shift to that way of thinking, the whole conversation about divestment and ESG becomes redundant, because all you are focused on is finding those companies that are helping us. So to understand that a little bit more, there's two companies that we invest in, both of these companies, just so I can make clear the difference. Teladoc is a digital health company that connects patients with medical professionals in the developing world. They work in 130 countries. It provides cheap and efficient healthcare and access to medical professionals. So we can look at this as a company and say, we like what you do, we think your product is helping people, it's generating better healthcare outcomes, and that's an impact company. An ESG company would be something like Unilever. So Unilever make, as you know, ice cream and face creams and various things like that, which are all really nice and useful, but as products, they're not necessarily solving a problem. But on the positive side, Unilever have made big changes to their operations to try and improve their sustainability. And they've done a lot of work on their supply chains as well. So if we're using those ESG measures, we can look at Unilever and say, actually, we like how you operate as a business and your commitment to sustainability, even though we're not overly excited about your end product. So to invest, to make an impact, our approach to doing this is to have two principles behind what we do: to maximize the return to investors and maximize the impact. And we use as a framework the United Nations Sustainable Development Goals, and quite a number of sustainable investment companies have started using these as their as their framework. So you'll be familiar with some of the problems that the world faces in terms of 2/3 of the world face water shortages, a third of children being overweight in the UK, global emissions need to be cut, hundreds of millions of people in poverty, and not with adequate access to healthcare. And these problems they're vast and they're complex. They're too complex for us as individuals to solve. They're too complex for governments to solve with their short time horizons. It needs serious levels of investments, and the UN think we need up to 7 trillion a year to invest to fix these goals. And this is where businesses and investors have a part to play. So to make things a little bit simpler, we further divide this down into 3 sectors: planet, people, and prosperity. And a lot of the thinking behind this, you'll be, if you're familiar with donut economics and the idea that we have to live within our planetary boundaries and what can sustain us, but within that we can find a way to provide a just and fair society. So we look for companies whose product is helping to solve some of these problems. So we look in sectors like healthcare, education, we look at sustainable infrastructure, we look at transport, we look at clean energy, and then we look on the negative side to try and screen some of these things out. And more sustainable strategies are taking this approach and going beyond this simple avoidance, but actively trying to find these good companies and reward them through good behavior. And as an investor, the good thing about this is that we see huge growth potentials in many of these sectors simply because of the amount of money that's needed to fix these problems. As Al Gore said that he saw sustainability as the biggest investment opportunity for generations. And there are different things that are driving this. So regulation, for example, more and more cities are regulating against diesel cars or plastics, and that drives companies to change. Consumer behavior is changing. We are less likely now to buy from companies that we think behave badly. And innovation, the speed of innovation is just dramatically increasing. The vaccine to COVID-19 was produced within a year. The DNA was sequenced within a week. And that kind of thing would not have been possible a few years ago. And this is really driving growth in the sectors where we need it most. And as an investor, that's obviously an opportunity, and the converse is true. There are certain sectors in the economy whose future profitability is severely limited by these changes in regulation. So again, a couple of the type of company that we sort of get quite excited about investing in are Tomra, who make reverse vending machines. So you go in, you put your plastic bottle in, you get a few cents change, and these are quite common all over Europe. And again, the changes that are being introduced in the EU mean that Tomra should be a very profitable company for years to come. There's companies like Ceres Power, who are developing some very clever steel cell technology that I can't really explain because it's too complicated for me. But I'm including it here just to show you it's more than just wind turbines. There are whole sectors developing in the world of renewable energy and improving the environment that we can think about investing in. And then an important part of anything that claims to be impact is the ability to measure it. So we try to measure the outputs of the companies that we invest into to produce for investors an impact assessment. So you can always see what's been done in your portfolio, as it were. So £1 million invested in the adventurous portfolio would have helped pay for the installation of 18 kilowatts of renewable energy capacity, or helped so many people in education, or give access to financial services. And this, again, is the real difference between an approach that seeks to avoid harm and one that seeks to invest in something that's positive, this ability to look at what's been done and understand the difference that's been made as a result of it. That's our performance history. So just a quick word on that. Now, one of people's key concerns when they're changing the style of investment is what's the impact going to be on the return? So if you're talking about your pension fund, obviously it's vitally important that you can retire as and when you thought you were going to be. So the return you get is important. We think over the long term, these sectors will outperform standard investing. And over the last 9 years, generally our performance, which is the pink bar, has been in excess of our benchmark, which is called the ARC Balance Benchmark. And it's just an aggregate of standard investment portfolios. However, if you take this approach, and if this is something you're doing with your pension, it's important to remember that there will be periods when an impact or sustainable portfolio will underperform a standard investment portfolio. If you go through a period in which oil prices are rallying, or you might have seen since January, investment markets have dropped in quite an alarming manner, that has particularly impacted some of the themes that we invest in, because they are particularly susceptible to fears about inflation. Companies that are going to be profitable in the future, innovative companies, will often find that they are susceptible to inflation because those future profits are suddenly less profitable. Inflation reduces them. So from time to time, we see periods in which impact portfolios do underperform. And I think as an impact investor, you need to be aware that that can happen and understand that we're looking at long-term outcomes. To just explain quickly an ESG approach in slightly more detail. So the way that we do this, again, is to try and maximise the returns, maximise the sustainability credentials by focusing on companies with a strong ESG track record and adding sustainable themes, but keeping the costs low. So one of the disadvantages to taking that very active approach to picking companies that you think are the best place to innovate and solve problems is it means the costs are higher. And that has an impact on you. It may mean that returns are lower. So the other way that you can approach this is using what we call tracker funds. So tracker funds will pick a market. So they might pick the UK stock market. And they will build an algorithm that selects the companies that you invest in. So there's no human intelligence saying, I think Tesco's is better than Sainsbury's, so I'm going to buy shares in Tesco's. There's an algorithm that's using data to select the companies for you, and that keeps the cost really low. Also means that the spread of companies that you invest in is much larger, so that the impact is slightly diluted, but you get the benefit of diversification and lower costs. Our approach to this is firstly to avoid harm. So again, by taking out the most controversial sectors like gambling and tobacco and coal. We then look to find those that benefit stakeholders, so funds of the most responsible companies. And then we can add in some themes. So if you're using tracker investments, you can buy things like clean energy ETFs, which will just buy a huge spread of renewable energy companies, or water companies, or green bonds, or anything like that. So you can get very low cost access to certain markets. Just to show you the last sort of comparison, we measure carbon output for the companies that we invest in. So this is emissions per £1 million invested on scope 1, 2, 3 basis. We've compared our two portfolios to the Ftse 100, which you'll be familiar with, and the MSCI ACRI is all companies world index, so it's the whole global stock market. Now, the Ftse 100 is a filthy collection of companies in terms of carbon. The Ftse 100 is a really old-fashioned index that's very focused on mining companies, oil companies. It's really unrepresentative of the world economy as it is now. It's very light on technology. So the MSCI ACRI is probably a better, more honest comparison here. But this is the impact in terms of carbon reduction. So Ftse 100 is over 2,000 tonnes per million invested, down to just over 1,000 for the MSCI World Index, and that goes down to just over 500 for the impact portfolio. So that's the reduction that you're achieving in your own sort of personal carbon footprint. And to be really clear, that carbon is still existing because those companies that you've switched your investments from haven't stopped trading, but your association with it is no longer there. The other measure that we try to use, I mentioned earlier that the UN Sustainable Development Goals, we measure companies as either being negative, so being harmful, neutral, so not doing anything that's particularly harmful but not particularly helpful, so that's Unilever again is a good example of that, or mapped to one of the SDGs, where we can show we think that company's activity is aligned to one of the Sustainable Development Goals. And again, then you can see the Ftse 100, we think a third of that index is actively harmful to the environment or society. And our impact portfolios, we're up to 84% aligned, and our ultimate goal is to get 100% of the companies aligned with one of the UN Sustainable Development Goals. So if you are thinking about your own pension, sorry, my cat is attacking my laptop as I talk. So you can hear some funny things going on, that's what it is. If you have a workplace pension, and anyone who is employed is probably enrolled in a workplace pension, you will be invested in a pension fund as selected by your employer. And they will be paying in a bit and you'll be paying in a bit. Also, enrolment is set up to make it as easy as possible for people to be part of pensions. So you will be probably enrolled in what is called a default fund. That's the investment fund that was selected by the company as being kind of suitable for most people. So you didn't have to make an active choice. Most pension providers will offer you a range of alternatives. Some will be very small, some will be much larger, depending on what your employer has chosen. So for example, Nest is quite a popular choice for employers. They offer an ethical fund, which has just started screening out fossil fuels. So that would be the only option that you would have if you were looking for something a bit more sustainable with Nest. Other pension funds, Aviva, Royal London, have a few more choices, and there's a range of different things that you can select from. So if you were thinking about changing within that to something that's more sustainable and more impactful, you'd have to get hold of that list from the pension company, go through it and understand what each option was. It's not always an easy thing to do because you'll just be looking at a list of names that say something like the Dum-de-Dum Sustainable or the Dum-de-Dum Ethical Fund. And it can be quite challenging working out what that fund is particularly trying to do in the context of everything. There's a really good website called Fund Eco Market that can help you understand what's happening with each of those. If you are lucky enough to have a final salary or defined benefit pension fund, there's very little you can do in terms of the investments other than perhaps speak to the trustees and lobby them to try and improve what they're doing in terms of sustainability. The other thing that people have is what's called a self-invested personal pension, which is where you can ask a company like EQ to look after the money for you, or you can select yourself from a much, much wider range of investments. So a self-invested personal pension will usually give you access to thousands of investment opportunities. So if you're familiar with platforms like Hargreaves Lansdown or AJ Bell, you'll be able to pick from, I think, thousands of different funds. And again, you need to go through that process of understanding what each one is doing, because the names can be quite challenging. What sustainable means in the context of one fund isn't necessarily the same as another. So it can take a little bit of time to research these different options. And again, I'd point you towards resources like Fund Eco Market to help you understand what choices you have there and what each one means. But before you go about switching investments in your pension, it's important to understand what's going to be right for you in terms of the actual investments aside from the sustainability criteria. So if you're somebody who's very close to retirement, you probably want a different type of investment to someone who's in their 20s. And fundamentally, there's two different types of investments that we use to put together portfolios. You have equities or shares, and they tend to grow quickly in value, but they can be really volatile. And then you have bonds, where you're buying a loan to a government or to a corporation. And that type of asset doesn't change in value so much, so you don't get the same level of volatility, but you get a much higher level of certainty. And the right mix of those will often drive the performance of your investments. So if you were a very nervous person who didn't like to see things move around in value so much, we'd suggest having more of on the bond side. If you're 25 years old and this is your pension fund, and it doesn't really matter if the stock market's going up and down like a yo-yo, you've got years and years to go, we'd suggest having more on the equity side and benefit from all of that growth. So it's important to start thinking about the right balance for you and what the particular investment is doing for you in your life, as well as looking at the sustainability angle. And then the second thing that you need to think very carefully about is diversification. And I've worked with a number of investors over the years who are so motivated by dealing with climate change. They quite happily stick every penny in climate change or renewable energy. But it's so important that you protect yourself against risk in any one particular sector by including a broad range of different investments. So think about healthcare and technology and social housing, as well as clean energy and climate change. So you're giving yourself as much protection as you can. It's important that you don't leave yourself vulnerable. So just these are three websites. Again, you're probably very familiar with Ethical Consumer, but the Good With Money website has loads of great resources about finances that all have an ethical aspect. And that's a great place to go for information. They've got stuff on there about bank accounts, investments, insurance. They're fabulous. The Fund Eco Market tool is a little bit more precise. It's more information about investment funds, and it allows you to select and filter things based on your criteria. And it's a good place to go if you're trying to work out what the difference between two different strategies is.